Welcome to Talking Sense. If this is your first time here, please do hit that subscribe button. In today's video, we're going to be talking about how to make money in a bear market. Lately, our markets have been trending lower, which has made it difficult for those that own stocks and wanting the market to go up. If you are only going long in a bear market, then the chances of making money are very slim. So to generate additional return, there's a concept called short selling. Now, this is the concept I want to explain today. So before we get into the video, there is a few things that we need to learn and understand. So let's have a look at that. First we have is collateral. Collateral is something you give, you pledge it as security for repayment on a loan. So if you want to borrow money, you give collateral and then you have the money. And in case you default, you can't service your borrowings, then the lender can liquidate your collateral to settle the loan. So it's a risk mitigation contract, sort of like that. Leverage. Leverage involves borrowing funds. So you're going to borrow money to buy something. And the thing that you are buying, you are hoping that it goes up in price so that you can make a profit to service the debt on the borrowings. So leverage can be your friend, but it can also be your worst enemy. The next two concepts that we need to know is short selling. So this is what we'll be focusing on mainly in this video. Short selling is when you borrow a security, like a stock, and then you sell it on the open market with the intention of buying it back at a lower price later on. So if you go and short sell, you are anticipating that the stock you are borrowing goes down in price. Short interest is the total number of shares of a particular stock that have been sold short, but haven't been covered or closed out. The positions haven't been closed out. So now that we understand that terminology, let's go to the next slide and continue with the video. We'll go through four things first. We'll start with margin call. Then we are going to look at short squeezes, margin calls, short selling rather, and liquidation. So these are the concepts that you need to understand when it comes to margin lending. That's when you borrow money and you give collateral. So your collateral can be your stocks, and you borrow against your stocks to use that money to generate more money. Short selling is pretty simple once you grasp the concept. In front of you, you'll see the picture. I'll go through the stages with you. Let's say you as a trader or an investor, you want to short a particular stock because you think the price is going to go lower and you want to make money from that. So you can borrow 1,000 shares or X amount of shares. It depends on how much your broker is willing to lend you and how much collateral you have. So for our example, we'll use just 1,000 shares. I borrow 1,000 shares of company XYZ, and I sell them at a price of $50, 50 Rand, or whatever currency you are trading in. So let's assume I borrow 1,000 shares. I sell them for 50 Rand each immediately. Remember, my plan is to rebuy them lower. That's short selling. That's the reason I'm borrowing them. So that costs me, I get 50,000 Rand cash. Now remember, I don't owe 50,000 Rand cash. I have to give back 1,000 shares at a predetermined date. All right, so that's where the risk comes in, because if the share goes up, then I don't have enough money to buy back the same quantity of shares. My trade is to buy the shares lower at a lower price with the 50,000 and then keep the difference. So let's assume the stock XYZ goes down to $45, 45 Rand. I then rebuy those same 1,000 Rand shares that I've just sold of stock XYZ, but now I buy them only for 45,000, but I've got 50,000 Rand cash. So I buy the same 1,000 shares, I return the borrowed stock, and I keep 5,000 for myself. That's the concept of short selling. Now, there are some risks involved in that, obviously, which we will look at now. But Here's a practical example for those of you that want to see it on a graph. Let's bring it down a little bit smaller to smaller numbers. Let's say I borrow Sasol Limited on the Johannesburg Stock Exchange. The shares trade for 100 Rand each. I borrow 10 shares. I sell them immediately. I get 1,000 cash. Sasol's share price now drops to 90 Rand. I rebuy those 10 shares again at a lower price, 900 bucks. I return the shares I borrowed. I obviously pay a small fee with the broker, and I pocket the difference. I make myself 100 Rand by shorting Sasol. However, the risk comes in is if I sell those shares. Remember, I owe those shares still, not the quantity, not the value of money I sold it for. So let's say Sasol shares don't go lower and actually go higher, 110 Rand. I only have 1,000 Rand cash. But for me to buy those same 10 shares, I need 1,100 Rand now. That means I'm 100 Rand in the red. I have to use 100 Rand of my own capital to cover my bet, to cover my trade, the risk that I've taken. So what do? I have to go immediately to buy those shares because I owe them, which makes a rush of new buyers coming to buy that share. And this is the concept of a short squeeze. It's when there's a lot of short interest in a stock, a lot of people that haven't closed their positions, and the share goes up. And they still owe shares, but they don't have enough money, and they've got to use their own capital to rebuy the same shares. So it adds this extra influx of demand for the shares, and it creates this spike in shares that we can see on graphs. So we'll come back to the margin call. We'll look at the short squeeze that I described first. So the short squeeze is exactly like I described. It's an unusual condition that triggers rapidly rising prices in a security like a stock due to the short sellers being forced to cover their positions. So to cover your positions is if the stock's going up, you've got to rebuy it at a higher price. So people will target stocks with a lot of short interest. So traders will buy stocks with heavy short interest to exploit the potential for a short squeeze. They want those that are trying to short sell the stock to be punished and go back and rebuy the stock and force them to buy at a higher price. So you have all these people covering their bets, trying to get in to get the shares that they borrowed to pay back to the lender. So this is what happens when you bet against it. You'll see this massive spike on the graph, and that's what it looks like. And that is what's known as a short squeeze. So if you are caught on the other side of that trade, it can be very detrimental and it can cost you a lot of money. So let's just backtrack to margin call. So when you are borrowing money and using collateral in your brokerage account or whatever account you are using, a margin call happens when the value of your security, your shares that you've pledged, fall below a certain level. So your broker will let you know, hey buddy, your collateral, the value of your collateral, the stocks that you have gone down. So we need you to deposit more money into your account to maintain that position. So the broker is minimizing risk, because if you can't pay back your loan and their collateral, the value of their collateral has gone down, the broker will be in the red too. So you can see how this all plays into short squeezes, liquidity crunches, and how the whole system works. We can have a look at an example. Let's say I gave Sibanye Stillwater shares as collateral, and I wanted to borrow money. My portfolio is worth 100K. And my broker allows me to borrow up to 75% of that money. So I can borrow against that 100K up to 75,000. I use my Sibanye shares because that's the value. The broker can liquidate that to get the money to cover the money they've borrowed out to reduce risk. So I use my 100K. The broker gives me 75% of that. I take I have 2,000 shares of Sabania at 50 Rand. That was my purchase price. That is equivalent to 100K. My collateral that the broker is willing to give me, or I give them for that certain amount of value, is 1,500 shares. So I transfer the shares to the broker. That's their collateral. They can sell it if I default to get their money, and I get 75,000 cash. So my intention to use that cash is either to rebuy new stock where I think is going to climb higher and make money, and then pay the broker and get my collateral back, keep the difference. Again, this is risky. If your collateral drops to 40 Rand, let's say the shares of Sabania now drop to 40 Rand from 50 Rand, you don't have 75,000 Rand. Well, the broker doesn't have 75,000 Rand as collateral anymore. They have only 60,000. So they are running at risk. So your broker will margin call you to protect themselves. They'll say, hey, Dave, you owe us either more capital or you need to buy more shares to keep your collateral at a certain level. Otherwise, we are going to liquidate you and sell your positions. This will be the next point we look at, because this is very important, because in the system of trading and on the markets, everything is collateralized and lots of leverage in the markets. So good shares can fall, not because they are bad, but because they have been collateralized and people are using leverage. So this is why we see sudden drops in stocks for particular reasons, not because the company is bad, like I said, but because the financial system is so collateralized and so leveraged. So there are a few ways to protect yourself against margin calls. You will see on the screen that keep some liquid cash in your account, because your collateral that you are pledging will fluctuate, and you'll have to transfer money into into the broker's account for them to feel secure that they don't have to liquidate you or margin call you. Don't hold on to losing positions very long. When it comes to trading, you have to get used to taking losses because it happens. So sell your position, cut your loss, close the collateral, close the account, get rid of your leverage. And also avoid trading high volatility stocks. So stocks that are prone to fluctuating to the downside 20% in a day, don't go for those stocks because the chances of being margin called are higher. So as I explained earlier, liquidation is when a trader's margin is insufficient to support their position. So just as Sabania dropped from 50 to 40, your collateral went from 75,000 to 60,000, your collateral doesn't support your position anymore. You'll have to either pay more money, get margin called, or if you don't have more money, the broker is going to liquidate you. So the trader is forced to close and the remaining funds are sold off. So your broker can also liquidate you without any warning if they feel that it's getting too much of a risk for them. That's to bring your account back into the minimum value. And this is what creates the cascade of selling pressure we see on the markets. Now, if you can understand which stock is being liquidated or sold off hard because there was a lot of short interest or leverage or collateralized loans, then you as an investor who has liquidity can know, hey, this is an opportunity in the short term because the stock is selling off and you can buy it at a cheaper valuation, not because the fundamentals have changed, but because games are being played on the market. So if you understand that, you will see the opportunity. Now we're going to end the video here soon, but there's one thing you need to remember. This is how the entire financial system operates. It works on debt, collateral, and leverage. And people want to maximize their returns as much as possible because that's how capitalism works. We all want to make more money all the time. And we come up with different investment vehicles or financial instruments to do it. So there's one thing you need to remember. When liquidity becomes tight in the cycle we find ourselves in, interest rates going up, people getting margin called, stocks selling off, there's a liquidity crunch. So even the best of the companies get sold, so people cover their positions. So things that are very liquid will get sold first because you can change to cash very quickly. You need your cash to settle your debts or to pay or to move around. And that's what happens. So when liquidations do happen, you have the opportunity, like I said. Now, to spot a short squeeze, you can find the short interest of a company. And if you can see that the short interest is very high, then there is a potential for traders to take the other side to create the short squeeze, to force the short sellers to cover their positions. Now, one such company is Rentgencel Bioscience Holding Limited. Their shares have significant short interest at the moment, and the CEO owns predominantly 80% of the company. So people are shorting shares of this company to more than what's actually available, which is causing a lot of short interest, which in turn could create a short squeeze. So I have this on my watch list because I want to keep track of it and see how it plays out. I will leave the link in the description for you to also keep track of this, read up on the shares, learn more about it, and see what happens and if the short squeeze materializes. So that's a wrap. I'll see you in the next video. I hope you found this educational. If you did, please share this with a friend and hit that subscribe button. And don't forget to comment and tell me where you think the market is going. Is it going up or is it going down? I'll see you all in the next video. Bye for now.